Okay, good afternoon everybody, and welcome to this Moore Kingston Smith webinar, where we will be looking at how coronavirus has affected the M&A market and what options may exist for business owners who are thinking about selling their business or indeed making acquisitions. Before we start, and while people are still joining us, just to note that like many businesses, we are all working from home at the moment and therefore subject to disruption by broadband providers, noisy neighbours, small children and attention-seeking pets. We will try to overcome any little local difficulties, but please bear with us if any unforeseen circumstances arise. We're hosting this webinar over the Fuse platform, which if you haven't used it before, it has a chat section which you can use to table questions, which we will then review and look to answer after we've finished the main presentation. Once we are done, we're going to be sending slides to everyone who has registered, so don't worry about trying to take notes. And also, I should say the webinar is being recorded, so it will be available to view later on. And I think we're going to send it to everybody if we can work out how to do that. So just to introduce today's speakers, I'm Nicola Horton, and I'm a principal within the Moore Kingston Smith corporate finance team. I'm joined by my corporate finance colleague, Paul Winterflood, and by one of our tax partners, Mike Hayes. For those who don't know, Moore Kingston Smith is a top 10 accountancy practice in London and the South East, and one of our particular areas of expertise is advising clients within the media and marketing services sectors. And that's what Paul, Mike and I spend the majority of our time doing. So this presentation is going to draw on what we are seeing in those sectors currently, but will hopefully be relevant to owners of businesses in other industries. So without further ado, I'm going to kick off by providing a bit of context regarding the market generally and detail how what was a pretty benign environment where multiple potential purchasers were active and minded to compete with each other for good businesses has shifted because of coronavirus. Here at Moore Kingston Smith, we've been tracking all UK M&A deals within the media and marketing services sector for a number of years now, and producing quarterly updates regarding levels of activity, trends, and so on. And at the end of 2019, we felt pretty optimistic that 2020 would see increased activity in this space, perhaps because of a more settled post-election approach to Brexit, but that was of course before coronavirus emerged. The virus has had and continues to have a significant impact on businesses throughout the UK, and not least on companies in the marketing and media space. Companies that are working in live entertainment, television, film, commercial production and events may have absolutely no income at all at present. Agencies may be less badly affected, depending on the nature of their clients, but will be experiencing project freezes, deferments and cancellations. So we now expect that UK M&A activity in the first half of 2020 will be severely impacted as businesses focus on more pressing concerns regarding their ability to trade through the crisis. And the data we've collected so far does show a decline in activity, as you can see from the chart. Last quarter, or the first quarter of this year, we recorded just 66 deals in the marketing and media space, which is lower than in any quarter in the previous year, and some 43% down on the comparable figure for Q1 2019. The decline is not surprising, given that there are currently some real practical difficulties in undertaking M&A transactions. Obviously, there is the immediate impact on companies trading that I've already mentioned. Generally, companies are valued on a multiple of trading profits or a sales basis, but how do you approach valuations when a company isn't making any profits or indeed any sales in some cases? And it's not just the issue with current trading. The fact is that nobody can be certain when restrictions will ease and when we will return to anything close to the old normal, or whether a second wave may lead to further lockdowns. And therefore producing credible, reliable forecasts on which earn-out targets, for example, might be predicated is nigh on impossible at the moment. There are also very human factors in play. M&A is about so much more than numbers and matching up clients and services. Successful M&A transactions, particularly in the media and marketing services sector, are about finding cultural fits and chemistry between key individuals. When you're social distancing, that means you can't get in a physical room with people, then you aren't going to make a lot of progress. Most buyers are not going to agree to buy a business if they've only ever met the management team over Zoom. There are also structural problems within the market. Many corporate and private acquirers ordinarily rely on bank debt to part finance their acquisitions. However, as we know, all the main UK banks are currently absolutely swamped with requests from businesses for loans under the various government support schemes, CBILS, bounce back loans, and so on. And they are turning all their resources towards those. So requests for new acquisition finance facilities are extremely hard to progress. However, even though activity is down, that doesn't mean the market is completely closed. We have continued to see deals announced, even post-lockdown in mid-March. So what is going on there? Well, I think the answer in the main is that most of the deals we have seen announced in the last few weeks were well in train before coronavirus loomed onto the horizon. A normal M&A process takes 3 to 6 months to complete. So any deals that completed in April or May were probably kicked off in the autumn last year. The principals would have been able to meet and agree terms for an acquisition while the business was operating as normal. And while deal terms may well have been altered once coronavirus emerged, if there was consensus that the deal made sense strategically, then it would have been able to go ahead. That being said, there are some structural drivers that suggest M&A activity can continue, albeit at a lower level during this period of uncertainty. And that will definitely support a return to higher levels of activity once we start to emerge from the current crisis. Those companies that don't need access to bank finance but have strong balance sheets with high cash balances should, if they are brave, see the current environment as a buyer's market. There are fewer of them about, there's less competition, so this is an ideal time to purchase and take advantage of reduced prices. And private equity has an awful lot of dry powder, funds they've raised that are looking for reasons to be deployed. We at Moore Kingston Smith have been talking to a number of PE firms over the last few weeks, and the majority say that they are very much open for business. Now, they are tending to prioritise their existing investee companies, so they're mainly looking at strategic bolt-ons for those, rather than necessarily looking at new standalone investments. But we expect private equity to be in the vanguard once the market starts to return to something approaching normal. And finally, we are aware that family offices, the investment arms of ultra-high net worth individuals and families, and sovereign wealth funds are actively looking at deals in the current market. And again, this is because the traditional competition is somewhat reduced at the moment, making this more of a buyer's market and presenting real opportunities for value investors. So to sum up the current state of affairs, the M&A market has definitely been significantly impacted by coronavirus, with the result that we expect to see fewer deals overall this year than last year. There are sufficient underlying drivers to suggest that the market will come back in due course, and probably the key to this coming back is at least the partial relaxation of the strict social distancing constraints that we are currently all observing, so that trade can resume, obviously, but also so that physical meetings become easier to arrange. For now, and probably for the immediate future, it is a brave buyer's market. So it is perhaps inevitable that those business owners that were contemplating putting themselves up for sale early this year will press pause, because they won't be certain of achieving a high valuation in a competitive environment. And so, referring back to the title of this webinar, that is certainly one sensible option for business owners at the moment. Wait for the M&A market to return to something closer to normal. Take advantage of the government support that is available, hunker down, protect your underlying businesses, make preparations for a sale, get your information together, get an advisor on board, but don't press go on marketing your business until later this year or early next year. Now that assumes you can afford or want to wait that long. Some owners will want to sell now for various reasons. We think the current pandemic will probably lead some owner managers to reassess their priorities and their long-term life plans, and that may mean they are open to a sale even though they acknowledge they may not achieve a peak valuation. My colleagues Paul and Mike will be discussing 2 routes that could enable owner managers to exit even in the current environment where willing trade counterparties may be a little thin on the ground. And then some business owners simply won't be able to afford to wait until later this year or early next year. if their businesses have been severely affected by coronavirus, they may run out of road before then and be worried they could eventually wind up in insolvency. In that set of circumstances, there are still options, and that is what I wanted to come on to next, namely accelerated M&A, which we believe is going to be a significant feature of the market in coming months. So what is accelerated M&A? Well, essentially, as it says on the tin, it is a shorter, highly focused, compressed M&A process where the aim is to sell a struggling, cash-strapped business, usually, as a going concern and preserve some of the business's value for the future. Essentially, it's finding a safe harbour for a business with a stronger and more financially viable partner. Any business can find itself suddenly in financial distress, and clearly we are going to be seeing more businesses struggling as a result of coronavirus. Businesses may lose significant customers, find themselves saddled with bad debts, be unable to trade. And while the various government support schemes will enable some to come back out the other side, others may just be deferring the inevitable. And when the VAT and corporation tax, rent holidays and so on eventually unwind, they won't have the capital available to carry on. So the idea for these businesses is to quickly find a home for client contracts and staff and keep them together so that with improved financial backing, they can continue to deliver positive results for all stakeholders. That tends to mean marketing to a very discrete group of potential acquirers, those who we already know do not require access to third-party finance, have limited due diligence requirements, and can contract speedily, because speed is of the essence here. The quid pro quo of speed, however, is of course price. An accelerated M&A transaction is unlikely to deliver significant value to selling shareholders on day one. Nobody's going to pay top dollar for a struggling business. However, it does hold out possibility for sellers to derive value in the future, provided the business they are selling generates additional sales and profits for its new owners, which is probably more than could be said for the alternative of the liquidation process. In our experience, businesses that benefit the most from an accelerated M&A process are those that have first considered a number of key action points. And these include making sure that all financial information is up to date, preparing a detailed cash flow forecast so they understand exactly how much runway the business really has, being able to clearly articulate the business's core value drivers to potential acquirers, being open with senior staff about what you are trying to achieve and ensuring their buy-in and commitment to a process, and being realistic about the business's value. Also, as you might expect me to say, you need to work with an advisor that has access to acquirers that are pre-qualified. And by that, I mean investors with financial means and the ability to transact at speed. You do not have the luxury of a normal marketing process. You need to be highly targeted and only spend time with potential purchasers who can commit to the constraints of an expedited deal timetable. As I said previously, a more traditional competitive M&A process could easily take 3 to 6 months to complete once we have pushed the button and started marketing the business. With accelerated M&A, we are typically looking to complete a transaction within just 4 to 8 weeks, and sometimes even quicker than that if circumstances dictate. Here at Moore Kingston Smith, we have a tried and tested process that addresses the challenges that businesses may be facing. First, we undertake a rapid assessment of the business to understand its current position and exactly how much time it has before it starts to run out of road. We advise on the implementation of short-term improvements with a view to managing cash and buying more time. We use this time to identify key value drivers and introduce the business to credible, pre-qualified potential buyers before selecting a preferred buyer and structuring a transaction which requires reduced due diligence and accelerated legals. So thus far in this presentation, we've covered the options. Option 1, wait for the M&A market to return to normality for those who can ride things out and have hopes for a better balance between buyers and sellers in due course. Or option 2, for those who can't afford to wait, accelerated M&A where a business may be saved, but the current owners need to be realistic about the price they will be paid. There are, however, other options for business owners whose businesses are not struggling, but who really prefer not to wait for whatever reason, family or lifestyle type concerns typically. And so now I'm going to hand over to my colleague Paul Winterflood who's going to explore the first of these options, namely the management buyout.
Thanks, Nicola. Afternoon, everyone. So in this next segment, I'm going to be covering what an MBO is, how they're funded, and what some of the key points you may want to consider in advance of one. So firstly, what is an MBO? So it's a transaction where the management team of the company acquires all or part of the company, often as an alternative to M&A. So the reasons why it might be an alternative to M&A are if there's a recession going on, so there's a limited appetite from buyers. There could just ordinarily be a limited buyer pool if, for instance, your customer base means you're quite conflicted, or if it's quite a niche industry. And often the third option is when, or the third time when an MBO is considered, is when when the business is highly dependent on the second tier management team who would leave if the business was sold to a third party. At a time where if the buyer's options are limited, it often means that the price is at a discount to an external sales process, but that is not always the case. And a time like this may be a time where a business owner may be able to realise more through an MBO than an open market sale. And I think the fourth key feature we're just going to touch on is that because in theory the management team know the business inside out, due diligence is normally only required if third-party financing is needed, and it always depends on the amount of third-party financing that is required. So it can often be quite a light assignment relative to a full sale process. That's not to say it's not absolutely not going to be a time-consuming process. There'll be a few points later on that I'll come on to, which can draw out the process. So the next area I'm going to cover is the funding options, because that is the real crux of whether an MBO is possible or not. So how are they normally funded? So the first funding area is typically a management contribution. It's accepted that the management team are unlikely to be able to fund the whole transaction themselves, but they are expected to commit personal funds to both demonstrate commitment to the transaction, plus also add a bit of contribute some value themselves. Banks, for instance, will often insist on money being put in by the management team. Sometimes it's not always in the form of cash. It can be in equity rolled over from the if the management team already have a shareholding in the company, but in a lot of cases it's generally expected that the management team should put in additional cash as part of the process. A typical amount that the management team could be expected to put in, a rule of thumb, it can be around 1 year's salary, but it's often done on a sort of case by case basis. But a year's salary is a fairly accepted amount. The second category of funding available to businesses is through leveraging debtors or using asset financing to provide security to a lender. In the case of a debtor financing, so invoice discounting, for instance, a small amount of due diligence may be carried out by the lender to check the quality of the debtor book. In many cases, certainly in ordinary times, lenders wouldn't necessarily ask for additional security at this time, or if they were asking for personal guarantees around this, then they would be limited. For media businesses or retainer businesses, they will have the greatest success in getting debtor financing, particularly where income is regular. For more volatile project-based businesses, invoice discounting and debtor financing is still possible. It's just that a lower percentage of the debtor book will be able to be drawn down. The third category we've got here is bank debt. So this is in the form of a more traditional loan, which are typically repayable over 3 to 5 years and are normally matched against the earn-out in a lot of cases. Depending on the amount borrowed, financial due diligence is sometimes required and might be required by the bank. We mentioned personal guarantees before, and in virtually all cases, banks will request personal guarantees from the management team to provide additional security, particularly in asset-light businesses such as agencies. Fourth potential area, and this is I've noticed on this bullet point here that that's for when for very much the larger businesses. Private equity is definitely an area of how a source of funding for MBOs. Nicola mentioned before that private equity houses do have a lot of dry powder, and that's certainly the case. So they will be looking for investment opportunities. But the key point for MBOs is the company does need to have the scale to justify it to a private equity house. Again, for private equity house, due diligence will be needed. If a private equity house does get involved, they're likely to put far more restrictive terms within the contract as well to protect their investment, and probably also request a board seat. Whereas for bank debt and invoice discounting, the bank's involvement is going to be passive at best. Then the final bullet is vendor financing. So where's a gap between the valuation that the seller is, or the business owner is hoping to achieve, and the amount that can be funded through those other 4 sources? The way to close that gap is through vendor financing. So when we're referring to vendor financing, it's in the form of either an earn-out linked to performance. It could be fixed deferred considerations. So every year you pay, the vendor receives a payment of a certain amount, or it could simply be another. The third way is through simply retaining a shareholding in the company. That would be the that would be the funding situation in normal times. At the current time, the funding options are slightly more limited, unfortunately. So again, taking them in turn, the management contribution, these are clearly still possible, albeit if the individual is trying to borrow personally against their house, or maybe taking out an additional loan, then these may be harder to finance in the short term, as banks are very much operationally focused on the emergency funding. So that's a green or potentially an amber. Debtor or other asset financing, again, that's an amber. It's still possible, albeit with probably with a lower drawdown percentage on a debtor book, or a lower loan to value ratio in the case of if there's any property. Appreciate for many of the businesses on the call, that's going to be unlikely. Nicola mentioned earlier that bank loans for acquisitions are particularly hard to come by at the moment, and that's definitely the case as well for MBOs. The banks are very much focused on getting on addressing the CBILS loans. So there may be a few acquisition and structured finance products available, but they're going to be very, very hard to come by. So we're expecting people doing MBOs to have to rely on the other funding categories. Private equity still have funds to deploy, but for many businesses, it won't be an option. So vendor financing becomes really, really key, and for many businesses, then it could be the sole route to structure a transaction, barring the management contribution. But it definitely remains an option, because clearly, if you're wanting to sell a business, then it's and you're wanting to realise the money now rather than in 2 or 3 years down the road, then you can put in place a transaction structure so to ensure that you get paid over, assuming the business performs okay over the next 2 to 3 years. So a few more key considerations to take if you are thinking about doing one. Firstly, this is the key. This is the point we've been discussing over the first 2 slides. Do your valuation expectations meet the match the funding options available? How much money do you require, and how soon do you require it? If you're expecting a big lump sum on day one, that's probably going to be very, very hard to come by, particularly at the moment. Whereas if you're happy to receive that money over a 3, 4, 5 year period, then it's a definite possibility. The next key point is the management team appetite and what their aspirations are. Taking on undertaking an MBO does fundamentally change their roles from managers, albeit if they do have a bit of equity, to owners, and that does require a shift, and not all managers have that appetite. So that's partly why the hurt money and the sweat equity is put in place. If the management team really aren't willing to take out personal guarantees, then how are you going to? Then it probably is going to be very, very difficult to fund this transaction. They need to be taking on some risk so that they are ultimately rewarded with hopefully having a good agency, which they can in turn sell in 5-10 years time. Lenders will also be assessing both the appetite and and also the ability of the management team to deliver, so that they can get their money back ultimately. So that's partly why they'll be doing due diligence and wanting to meet people that's through the process. Next point is the vendor protection. So these are clauses that will be put in place through the contract negotiation. This is done at the back end of the process. So depending on the structure of the transaction, the vendor will want to make sure that they are protected through the earn-out. So if you're being paid out over a number of years, you'll want to make sure that certain things do or don't happen. So there's often standard clauses around no dividends can be paid above a certain amount, or no bonuses can be paid until you've received all the money that you are owed. The more value that is paid through the earn-out versus on an upfront payment, the more protection that is required, particularly if the earn-out is linked to profit rather than a fixed amount each year. And this is the stage where the lawyers will get involved to help advise on this contract. The final key area here is also on the tax structuring. There's various tax issues that can be encountered, particularly if the equity is retained by the management, or if company leaves or cash leaves the business as part of the transaction. And so tax advice is absolutely key if you are considering an MBO. Issues can be quite costly if they're not looked at in advance, and people far more qualified than me, such as Mike, would be far better placed to advise on the tax for an MBO. So I'll move quickly on to the next slide. So finally, if all this doesn't put you off, the final slide shows a typical process. We've also generally the fastest possible timeline that an MBO can take place over. The timeline can get drawn out at various points. I think one of the key differences between an MBO and an M&A process is they can be far more emotive, as you've got, rather than being sat on the opposite side of a table to maybe a business, maybe an acquirer who you've had a few meetings with. You could be sat on the opposite side of the table to friends and colleagues who you've had a relationship with for 5, 10, 15 years, and that can mean that it does become quite an emotive process, particularly if there can be quite significant differences of opinion around particularly around the contract stage, is where these issues really come to light. So this is the typical process for companies that we're advising if we were going from start to finish, and also raising external financing. At the moment, if really the only options are vendor financing and management management contributions, then this process can be reduced fairly significantly, because you're not having to go through the marketing phase, you're not having to go through the due diligence phase, and also the initial phase will be a lot simpler too, because once you're not having to assess who could potentially fund it. So firstly, the first stage is the preparation. So that's the financial situation, how the transaction can be structured. If you're a business owner, this may be the stage where you're speaking to the management team to see if they have the appetite to do this. If they don't, then you may as well bring these conversations to a fairly quick end, and sort of consider other options. Moving forward, then future stages are sort of constructing an offer and transaction structure, and then ensuring it works from a tax perspective. And then we mentioned the final stage, which is the contract negotiation, very much led by the lawyers, but there'll be all the various points from the rest of the transaction structure will be fed into that process, and the complexity of this does depend on the nature of the transaction. So if it's heavily vendor finance, so through earnouts and deferred considerations, then that can mean that the last stage could be pretty complicated to get everybody comfortable with the transaction. So hopefully that gives you a good background on the process. I'll hand over now to Mike, who will discuss the fourth potential option available to you at the current time, which is employee ownership trust.
Thank you, Paul. Good afternoon, everyone. So I'm going to spend the next few minutes talking about employee ownership trusts, which for the purpose of this call, I'm just going to refer to as trusts for the remainder. These have been around now for 5 or 6 years, and they were introduced following a government-sponsored review of employee share ownership called the Nuttall Review, which took place in about 2012. And the whole idea of a trust of this type is to create a share ownership model that's rather similar to John Lewis's, not exactly the same, whereby you create a trust, you're able to sell your shares to the trust, and the trust actually holds those shares for the benefit of the employees. Now, it's not true employee share ownership, because the employees never get to own the shares unless the trust distributes them, which has tax issues. So they're actually held for the benefit of the employees. Now, to incentivize such structures, there is a very generous capital gains tax saving for the seller into the trust. They can actually have a capital gains tax-free disposal, which you can't do much better than 0% tax. So that is a really good incentive, but that is a generous tax relief, and with all tax reliefs, because money is being given away, there are lots of conditions. So for the remainder of the talk, I'm going to sort of run through some of those conditions, or the main ones, so you're aware of them. So why use trusts in this way? Well, some people philosophically want to spread the ownership of their business. Maybe there's no family or logical management succession, so it helps engage employees, etc. So there might be good reasons like that. Perhaps management do want to actually have a disposal, and they see this as an attractive alternative now that entrepreneurs' relief is being significantly curtailed. Is only available really on gains of up to £1 million, whereupon it was 10 million before the budget. Maybe a trade sale, as you've heard already, is not really possible. And maybe even the management buyout is not really possible, perhaps because you haven't got the management team in place, or maybe the management team doesn't have the appetite to enter into personal guarantees, etc., whatever's needed. And it also means that you can take advantage of a very generous tax regime, perhaps anticipating an onward sale that you might have down the road. The advantages, it allows employees indirectly to have an interest in the shares without actually having to use their own funds, so that's good. The shareholders can sell their shares to the trust at full market value. As I've mentioned before, there's no capital gains tax subject to certain conditions, or any inheritance tax or income tax liabilities on the disposal of the shares to the trust. So it is very attractive from a seller's point of view. You don't have to sell all your shares to the trust, but the trust must always have more than 51% of more than 50% of the shares. In the slides, it refers to 51%, but that's basically means more than half, and that must occur at all stages. The directors or current shareholders, if they wish, they can remain in situ post disposal and can still receive market value salaries, etc. So they don't actually have to sever their connection with the business. Although I have to say that if you're actually spreading the effective employee ownership of shares, you would also probably have to put in place some sort of mechanism for having a wider representation on the board from the workforce. And maybe I'll mention that near the end. And rather like an MBO, it's a more friendly purchase, so it can be a quicker process. The legal documentation could be a little more concise, and potentially it has lower fees. So that's another attraction. Let me move on to the next slide. So how do you structure an employee ownership trust? Well, firstly, you have to establish a trust, and that's simply by having an appropriately worded trust deed, and you need trustees. Typically, you would have a corporate trustee, which could actually be a professional trustee, professional corporate trustee, or you could form your own company to act as a corporate trustee. Either way works fine. The shareholders, the process is going to be documented other than the trust, rather like an MBO or a traditional sale. So there will be a share purchase agreement whereby the shares are sold to the trust by the sellers. That might be a shorter document than a third-party sale. And it is important for there to be a market valuation undertaken on behalf of both parties. And that's something that's quite important. Funding the trust is probably one of the key issues. And in many ways, it's not dissimilar from an MBO. There are a number of alternatives which are going to run through, and it could be any one or a combination of the following. So if the company says it's got plenty of cash, maybe it's got sufficient cash on the balance sheet to be able to contribute to the trust, and that money can be used to buy the shares from the sellers. It could in part be paid out of future profits. So maybe there's some cash up front because there's some cash on the balance sheet, but maybe the balance is payable by installments out of future profits. Or maybe there is some borrowing, say with bank debt. And again, that is rather similar to an MBO with potential difficulties at the moment for the reasons you already heard. There's no reason why either the company or perhaps the trustees can't borrow funds to help fund the acquisition. And as I said before, typically one of these type of transactions is normally structured using more than one of those particular alternatives. And just to see that diagrammatically, there you have a diagram which I don't propose to go through, but it does actually show how the thing works in picture format, if that is something that's helpful for you to look back at in the future. And as I said before, there are a number of ways of actually funding it. Some quite well-known businesses have actually done this. We've had an increasing number of clients do it, and it's become quite popular with clients over the last year or so, and I think it's beginning to gain traction in the market. But there are quite a few well-known names who have actually gone public about having done this themselves, and the one that made the most fuss was Richer Sounds, I think, which you might have heard about. I think that happened sometime last year. What are other requirements of an employee ownership trust? Firstly, you can only do this if you've got a trading company. So this will not apply if you're wanting to sell your investment company. It will not work. Secondly, as I mentioned earlier, the trust must have a controlling interest defined as 51% plus throughout. Not just immediately after the sale, but throughout. And if the ownership falls below control at any point in time, the capital gains tax benefits that you've obtained for the seller will actually be unravelled. And I'll perhaps come back to that in a minute. It doesn't actually have to own 100%, but as I said, must not dip below 51%. A few points to mention there. The first thing is, an owner might be tempted to actually sell 55% or 60% to the company, to the trust now, and perhaps think about selling the other 40% down the road. The capital gains tax relief is only available on the first sale to the trust. So in my example, the initial sale of 60% will attract the capital gains tax relief. The second sale down the road is 40% of the shares will actually be taxable in the normal way. So if you like, you can only get your tax relief on one visit to the well. Second point is, if you want to sell just over control, you do have to think very carefully about what might happen down the road to cause that interest to be diluted. And I would be questioning any clients very closely if they're only looking to sell 51%, 60%, maybe even 65% of the shares to the trust. Because what I might say to them is, well, what happens if you want to raise equity finance and you need to issue shares? That might bring the trust holding down below 50%. Or maybe you might have share options you want to grant to some key executives. Again, exercise of those options might dilute you below that particular limit, which is not particularly attractive. And as far as the pullback of the capital gains tax is concerned, is if this 51% test is failed in the year of the disposal or the following tax year, the tax liability, in other words, the unravelling of the capital gains tax liability, falls on the seller. If it happens after those 2 years, it falls on the trustees. So clearly there's an interest in both parties to actually make sure it works, and there are no circumstances where it can reasonably fall below 51%. It's got to be available to all employees, and they've got to be eligible to participate in this on the same terms. I can mention that a little bit more about that later. Certain people aren't allowed to participate. Anybody who's owned more than 5% of the shares in the last 10 years can't be a beneficiary of the trust, and nor can trusts exist where over 40% of the employees are shareholder directors. So what does that mean? So let's take an example. If you've got a consulting company which has got 2 shareholder directors and 2 employees, that would actually fail the 40% test. So that business would not be able to sell its shares to a trust like this and gain all the tax reliefs. So you've really got to have a situation where the employees outnumber the shareholder directors. As I mentioned earlier, the trust must hold the property for the benefit of the employees on an equal basis. But when it says equal, it doesn't mean exactly equal. They must participate on the same terms. So one of the reliefs that you get is that the company, once a trust has been established, can pay bonuses to the employees, and up to £3,600 of those bonuses each year can be free of income tax. They're not free of national insurance, I must emphasise, just free of income tax. So that's quite attractive for employees. You can actually devise a scheme, which you should do, and it must be in writing, as to how you allocate any bonus entitlement between employees, and you can weight it. You can weight it according to length of service or according to level of salary or similar. And typically when I've seen these put in place, and we've actually helped advise on some of these, what you typically do is establish a point structure to make the numbers easy. So say for each band of say 5,000 salary, you get 1 point, and perhaps every band of 2 years service, you get another point. And you can actually aggregate those factors if you so wish. So it's not based purely on one or the other, but you can't multiply your points, because if you multiply your points, that's going to distort the allocation in favour of the highly paid or longer serving employees. So you've got to be careful about how you do it, but there is some degree of weighting. As I said before, the reliefs, there's 0% CGT. I've talked about the possible clawback if the 51% condition is not satisfied throughout. It's also possible to think about using offshore trustees. If you think there might be a third-party sale due at some point in the future, by actually establishing offshore trustees, you can take the whole disposal outside of capital gains tax when you sell to a third party. Now that is something not to be done lightly, because offshore trustees are based in tax havens and they know how to charge fees. So it's generally a more expensive process, but it's something that may be worth considering. And as I explained before, if there's a distribution of profits by the company to employees in accordance with a mechanism that meets the conditions I outlined, then £3,600 per annum of that per employee can be income tax free. So what about the opportunities? How can we actually help? I've got a horrid feeling I missed a slide, but maybe I didn't miss a slide. Okay, so how can we actually help with this process? Well, certainly we can help giving the initial advice about how you structure this, how it works. We can actually help, for example, if you're a partnership first, a partnership can't participate in this because it's only for companies, but maybe you could actually incorporate the partnership into a limited company, which then means you've got the possibility of using an employee ownership trust. Maybe there's other sort of reorganisational type work that needs to be done first. We can help with the establishment of the employee ownership trust and the appointment of trustees. If you want to use offshore trustees, we can make the appropriate introductions. We can certainly do the share valuation to ensure that the transaction's at market value. And rather like an MBO or a third-party sale, you could actually structure the consideration for this as cash up front plus an earn-out. We have had one client that's looked to do that. My preference with all things related to tax is to try and keep it more simple, but certainly you can sort of replicate any type of consideration structure that you might find in the marketplace. There needs to be a shared purchase agreement, which our legal team can help you with, and that needs to be reviewed. As I said before, because this is a more friendly deal, it's a little bit lighter on things like warranties and indemnities. Certainly tax advice on whether the qualifying conditions are met are crucial, because that is crucial for that. So it's as simple as that, really. We can help, Paul's and Nicola's team can help with financial modelling to help make sure that this thing actually is sustainable, the consideration structure is sustainable, and that can certainly help in terms of then actually going to get borrowing, and I've mentioned that at the bottom. So certainly we can help with finding bank finance if that's required, with all the procedures that go around that. This is a transaction in securities, so there is a clearance process. to make sure HMRC don't try and tax the proceeds as a dividend. It's unlikely that they would, but there could be some circumstances in which they perhaps don't like exactly what's being proposed. So that's something we can actually help with as well. My view is that, well, based on experience, I think EOTs are going to grow in popularity. I think people are realizing that this is a genuine alternative to the usual ways of exiting the business, and it may be something that appeals to the existing owners from a more philosophical point of view. In other words, letting the employees basically have beneficial ownership of the company going forward. But as you've heard earlier on this seminar, it may be it may be one of the only games in town, or one of the most likely games in town that you're likely to get a result on. So it is going to be, there are significant market drivers, I think. And the other point is, as I mentioned, entrepreneurs' relief has been severely curtailed. And you know, this is potentially better than entrepreneurs' relief. You potentially have a 0% capital gains situation, subject to meeting all the conditions. So that, in my view, has got to make it more attractive than other exit routes, where potentially you're going to pay tax at 20% on most of your capital gain. And I think that was me done. So I'll hand you back to Nicola.
Thanks, Mike. Thanks very much. So as I said to people at the beginning of this, but you might not have heard me because you're all busy dialing in, there is a chat function at the bottom of your screen, so please do feel free to post questions in there and we'll do our best to answer them. We've got about, well, slightly less than 10 minutes, I think we said we'd take an hour, so 4 questions. Haven't seen that many yet, but I'm certainly happy to take some more. But in the meantime, we have had a couple. So one's back to you, Mike, I'm afraid. So put your tea down. There's a question about the fact that you need a market valuation for an EOT. And are there going to be any issues in the current environment on being able to justify a high enough valuation?
Well, the answer is yes. It has to be the case that unless you're in one of those businesses that's benefited from the crisis because you make PPE or something, and you've been, you know, your supplies have gone, your sales have gone up, it's almost certainly the case that valuing the company is a more complicated affair, because what the usual method from a tax point of view is you start off by looking at historical earnings for the last few years and then sort of comparing that to what you might expect. Well, sort of historical earnings are a bit more less relevant now because the virus might have had a significant impact on your business. So I think it must make it more difficult to actually come up with a valuation, and certainly to sustain a valuation that you might have actually achieved say last December, for example. Having said that, you know, it largely depends upon whether your view on the impact of on your business is that it's a blip for this year, and you'll go back to normal sort of the normal state of affairs next year. And if that's the case, then maybe you can it will have less effect. But it is a difficult issue, and the answer must be yes. It must have make it more difficult to sustain such a high valuation. I should actually add that the valuation does not need to be agreed with HMRC. It does have to be a genuine arm's length valuation undertaken by a third party, but there's no mechanism for agreeing the value with HMRC.
Okay. And I suppose what you were saying earlier about if it is a slightly lower valuation, but the benefits of getting that at zero tax versus something a bit higher, but having to pay 20% tax, people should take that into account as well, probably. I've been sent a lovely question here, so I'll pick up on this from Simon, who says, how do you get onto our list of pre-qualified acquirers? So the honest answer is, outside of this meeting, these slides, if I click on through, we'll have our contact details in, but you've got them. They'll get sent to you anyway. Please do drop us an email, and we'd love to chat, is the honest answer. Clearly, at the moment, Paul and I and other colleagues in the team are compiling lists of people who say, yes, we're brave and we have funds and we're able to transact quickly and we're looking for opportunities. So we'd just love to have a chat with you and find out exactly what you're looking for. And that's really the answer to that one. Sorry, my chat has disappeared, so I just load it again. There were some other questions popping up. Bear with me. Oh yes, there's one here where somebody said they're interested in option one. Basically, they'd like to wait. They'd like to sell their business now, but they want to sell when things are back more to normal. So they're asking, how long will they have to wait? And I'm afraid the answer to that is we don't know. But you know, clearly, if I'm being hopeful, I would hope that we start to see some return to normality in the M&A market towards the end of this year. Maybe it's early next year. I think the one thing I would say is that there are a number of processes right now that are on hold. We have some on hold. We're aware of a number of other firms that have them on hold, but they're all ready to start again when the situation gets better. So if you're only just starting to think about it now, I think the very strong advice would be at least to start in on the initial work and be prepared so that you are ready to press go as soon as the situation does get better. Don't just start making preparations for it when it's already got better. You'll be at the back of a long queue. Yeah, the market will come back. It always has done. Someone is asking, Mike, can you add surplus working capital into the EOT valuation?
Yes, you can do. Thank you, Nicola. Yes, you can do. There's no reason why you cannot. This can be, you know, that can actually form part of the consideration. Actually, you can actually work out what the surplus working capital is and add that to the base value of the business, rather like you would do on a third-party sale. So that is not a problem. I think it's probably fair to say that rather like MBOs and unlike third-party sales, you know, it may be that the price is not driven as hard by the seller as you would do if you're selling to a third party. But so you might not be wanting to push every part of it, because particularly if this is going to be a self-funded acquisition, effectively by out of the company's existing resources or future profits. But yes, there's no reason why you can't do that.
Okay. Christine asked, apologies if I've missed this, but how is an EOT financed? How would current shareholders get their cash, both share value and balance sheet? Do you want to just quickly go over that again, Mike?
Yes, I'll go through that. Essentially, it's going to be funded out of either the resources of the company, either current or future profits, which are then contributed to the trust and then used to buy out the shareholder. And this may mean, of course, that it can't be done all at once. And in the ones that I've dealt with, there has been an element of upfront cash plus an instalment arrangement whereby the company makes further contributions to the trust out of future profits to help repay those instalments. And of course, the trust can borrow, and I mentioned this earlier in the presentation. The trust can go to a bank and borrow rather like it could do in an MBO situation. But I think if you missed the beginning, you'll have heard from my colleagues that borrowing from a bank is probably not as easy. If it ever was easy, it's certainly not as easy as it was prior to the current crisis.
Okay. I've got a question here that says, do you think buyers will look through the COVID interruption period a bit like the CBILS loan? I guess what that is asking is, will buyers discount it once when they're evaluating how to value a target business once we return to more like normal? And I think the honest answer is yes, people will, but you'll need to be out the other side first to show that you have come through it, i.e. it was a blip, it was an extraordinary year, and therefore when you're looking to value the business, you should look at what it would have done absent this virus having hit. That's the only logical way to proceed. I don't think people would accept a valuation based on multiple of last year's trading. They just won't do it to strike a deal at that level unless they are in dire circumstances. Sorry, I'm hoping I'll get into all of these. I am conscious of time, but if people are happy, I'll carry on. I've got a question from Prina, who is asking about, in terms of getting ready for a third-party sale, can we give examples of the work that is required in preparation in the meantime? What sort of docs should we be sorting, stroke filing? Prina, there's a very long answer to that question, so I think probably the answer to that is drop me a line after this presentation, and I can happily talk to you about what it is you need to do and how we can help you in that regard. It's probably too long for this. Sorry, I'm just flicking through these. Daryl, yes, please drop me an email. Is the honest answer to yours. I think. Oh, Simon's asking interesting questions. He said that the shortened completion window, when I was talking about accelerated M&A of 4 to 8 weeks, could lead to cutting due diligence corners. Yes. And so increase risk to the acquirer. Doubly, yes. Are there any steps that can be taken to minimise that increased risk? Well, I think on the one hand, you are doing less due diligence, but you're getting the trade-off is in price. You're paying less for it. So that is, if you like, minimising your risk. Your cost to your price to play is lower. But of course, in a foreshortened process, it'll be the result of a commercial negotiation between buyer and seller as to what warranties and indemnities are required and what sellers may be prepared to give, and they may be wider ranging than in a normal process where you've had a chance to do greater due diligence. So I think it's a question of trying to get covered to the extent that you can, but acknowledging that if you're paying less money, you have less at risk, and therefore you are going to assume more risk in terms of the business that you are taking on. Probably just a straight trade-off.
One more, Nicola, from William Mundo, who says, "What are the downsides, negatives from the EOT scheme?" Well, I think the compared to a third-party sale, for example, you were probably not going to get as keen a price as you might do from a third party. But also, rather like an MBO, this is largely either going to be self-funded or there's going to be an element of bank borrowing, which then has to be satisfied out of the profits of the business. So either directly or indirectly, this is self-funded. So, so you're not having a third-party purchaser who's got bags full of cash, and you know you're going to get your money providing you deliver your results. So there's always got to be a concern as to whether you're going to get paid in full. And clearly, if you're going to actually sell to an EOT and maybe actually hand over the management of the business to somebody else, you will need to think about the risks associated with that and what protections you can take to actually help. But that's exactly the same as with an MBO. It's just that an MBO, you use a new company. In this situation, you're using a trust. Essentially, it's the same commercial risk, I think.
And Mike, I can see one further question, which was a follow-on, which was, does the EOT have to distribute all the shares, or can it hold some back for future employees?
No, the way it works is that the trust will actually sit on the shares. It would not normally be actually distributing the shares. Now, you might want to distribute the shares down the road, but the purpose of this, John Lewis's, it holds all its shares in the trust. It hasn't actually distributed them. So it might be that the trust remains in place indefinitely, and you don't actually transfer to trust shares out. One of the things that is important to remember is, I said that everyone has to participate in the trust on an equal basis, and it does mean that you can't actually transfer shares out to employees on a discretionary basis, because then you're falling foul of that similar terms rule. So you can't, for example, use shares in the trust to satisfy a share option to a new finance director, for example, because that will break the rules.
So I suspect what that question was more driving at is whether future employees coming in can benefit from this, or whether it's for those employees at the time that the transaction takes place.
Yes, it's for the benefit of current and future employees. And one of the things I think I missed, which is now I realise what it is that yes, it's for the benefit of all employees at the relevant time. You can have exclusions for like probationary periods. So if you take somebody on a 6 months probation, maybe you couldn't actually provide that they don't benefit from the trust until they're satisfied their probationary period. You can also exclude people from, for example, going through a disciplinary process, or perhaps have given notice or had notice given to them. So there are certain situations where people, you can exclude people, but broadly it has to be for the benefit of all current and future employees.
Excellent. Okay, well, I think that does cover all the questions that we've been asked. I'd obviously like to thank everybody for joining us. Look forward to receiving the slides in due course. Those are our contact details. You'll get those through from our marketing team in due course. And please, would love to pick up with any and all of you about some of the points that we've raised on this seminar. We have run over. I'm sorry about that. So and I do see a few people have now dropped off. So apologies for that. But I hope you enjoyed this webinar, and we look forward to seeing you at future events. Thank you very much.